In this episode, we speak with Jeffrey Stevenson, managing partner of VSS Capital Partners, a private investment firm that invests in healthcare, business services, and education companies. Since its founding in 1987, VSS has partnered with lower middle market companies, working closely with management teams to facilitate their next stage of growth. With approximately $4 billion in committed capital across 8 funds, VSS has completed over 100 platform investments and more than 600 add-on acquisitions. Jeffrey has overall responsibility for the management of the firm and each of its funds. He joined VSS in 1982, shortly after its formation, and founded its private equity business in 1987. He currently serves as chairman of the investment committee and has been a board member of over 31 portfolio companies. VSS was recently recognized by GrowthCap as a top private equity firm of 2025. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of GrowthCap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Jeffrey, great to see you. Thanks for taking the time.
My pleasure. Thanks for having me.
So I think this is a first where from college, someone stayed at the same firm, built a firm over a 40-year period. Clearly, you love your profession.
Well, yes, I do. And I appreciate you reminding me how long I've been doing this now. So yeah, the quick story is that I graduated in 1982. I joined what was then called Vronis Suler and Associates. It was a merchant bank advisory business focused on the media industry, started by John Vronis and John Suler. So we were not in the fund business back then. We were in the advisory business. But the origins of the firm really go back to being specialized in a particular set of industries. And in our case, that was media. Not very common back then, but that was something that was a key differentiator for us. And of course, those were also early days for private equity, which, by the way, wasn't called private equity back then. So it was exciting days that led us to starting the first fund, which I started in 1987. So for a number of years, we had the 2 lines of business. The original 2 founders continued to run the investment banking advisory side of the business. And then, of course, I ran the private equity side of the business. And then over time, we exited the investment banking to focus on private equity. And as they say, that's the story that has unfolded since then.
It's pretty impressive because private equity, or whatever it was being called at the time, was a new thing. And you weren't that far out of college. I mean, you're 5 years out and you decide that you're going to start this business. Did it seem at that time to you risky, or you had enough confidence that, yes, this is going to work?
Well, we had the benefit of not knowing what we were doing back then. Oftentimes businesses get started that way. But I'd say for us, the epiphany, if you will, was that we were working with a firm that was quite prominent back then by the name of Forsman Little. Mm-hmm. And if anyone reads Barbarians at the Gate, they'll know who that firm is. And we were doing an investment banking deal with them. It was in the television business, and the sources and uses at closing were a little short of funds. So we were forced to contribute our investment banking fee into the equity, which at the time we weren't very happy about. And then I'd say 2 or 3 years later, when that deal exited, of course, that fee, which was in the form of equity, then returned many multiples of what it was originally. And that was really the epiphany that said to us, wow, this is really a great business, a better business, and we ought to figure out how to do it. So I had been at the time doing a lot of private placements with insurance companies, helping to arrange financing for lower middle market companies, entrepreneurial businesses that were making acquisitions. So I knocked on those same doors to raise capital for this first fund of ours. And lo and behold, we started getting commitments, and one thing led to another. And we raised a fund that was originally targeted to be 25 million. We ended up raising 57 million, and that was our first fund.
And now, fast forwarding a few decades to present time, you're now focused on a few sectors or several sectors. How do you kind of look at that in terms of your allocation of resources? Maybe if you could tell us a little bit about the sectors you focus on, then how you approach each one.
Sure. First I should just comment on, how we transitioned from the original focus of media to what we're doing today, which is really more tech-enabled business services. So it's not necessarily a logical transition, but it certainly seemed logical to us at the time. So if you think about media back then, so we're talking about newspapers, magazines, TV, radio, cable, those were really content businesses that were delivered in the form of then traditional media, be it print or it was television or radio. And as those businesses started to get disrupted by the internet, we started to shift more to content in the form of information services that was being delivered electronically. So initially it was financial information, business information, healthcare information. And that was really the first, segue from traditional content-oriented, more consumer-oriented businesses to then the B2B side of the business. And of course, over time, and this is probably a transition that took place over the better part of 10 years to fully transition. But over time, then it became information businesses that were tech-enabled that were then organized vertically, because you wouldn't have an information business that was more general like you would have on the consumer side, such as newspapers and so forth, or television back then. So as time went on, we got into information services. And of course, as information services then developed, it wasn't just the distribution of content, it was also the analytics and the data and the ability to manipulate that data through technology over time. And I'd say we fully made the transition. We probably started that transition around 2000 or so. And we probably fully made the transition certainly by 2010. And when we started our current fund strategy, which we call structured capital, which was in 2005, we were a good ways through that transition at that point in time.
And talking about these sectors, clearly you've seen these markets evolve. Are there areas of technology that you've always stayed clear of, but you just said, that's not where we want to focus? How have you maintained, to some degree, this focus in certain areas? Because I could see the tendency is as you grow, you want to do more, you want to branch out. There's other shiny objects, so to speak.
So I think that the first thing that I would distinguish is when we talk about technology and tech-enabled businesses, we're not investing in technology per se. So we're not developing technology. We're not a VC firm. We're not investing in businesses that are early stage or startups or negative cash flow. So we're investing in businesses where the technology is important and necessary to conduct the business, but it's not in a development stage. Mm-hmm. The first thing is that these are businesses that are further along in terms of their stage of growth. They're profitable. They have cash flow. They're lower middle market businesses, so they're smaller, but the risk that we're taking is not in the development of the technology per se. I think the other thing that's critically important as we look at all these businesses that are tech-enabled business services is how embedded are they in the workflow of their customer base? And the more embedded means the stickier, the harder to change, and the higher the level of the recurring revenue. So that's sort of the other part of what we're looking for as we're evaluating prospective businesses.
In terms of the firm itself and how you've grown it, has your philosophy around firm building evolved over time in terms of these are the types of people we want to recruit, this is the type of culture we want to have? You've been doing this 3-4 decades. So how has kind of your firm building philosophy evolved?
What I look for and what I do, of course, is different than what I was doing, several decades ago. I'm now more in the mode of building the next generation and focusing on the next group of people, who are leading deals and sitting on the boards. And besides all of the things that, you would expect in terms of being, smart and hardworking and so forth, which is sort of a given that you're going to have those capabilities. To me, the key is passion. And it sounds a little bit like a cliche, but, it's important because it's a business where you've got to work really hard. You've got to have a sustained level of interest and enthusiasm for what you're doing. And if you don't have passion that underpins that, you really can't sustain that over decades. So I'd say that is, number one. And number two is that we're working with entrepreneurs and entrepreneurs that have built a business to a certain level. We think of them as being at an inflection point. They now need a capital partner to take it to the next level. So we're looking for people, and we want to build a firm that's going to be able to become immersed in that business, not in terms of day-to-day operations, but more strategically, that's going to be hands-on and helpful. And most importantly, a partner with the management team, as opposed to dictating this and that. So the partnership is critically important, and adding value by helping, I like to refer to it as turning companies into platforms. So how can we help that entrepreneur take the business to the next level? And how can we advise them in terms of building out the management team, adding KPIs, just taking the business and putting it in a position so that they can be effective in terms of executing add-on acquisitions. And add-on acquisitions, of course, are quite common in the private equity business. We've been doing it since the beginning. So we've invested in a little over 100 platform companies that have done over 600 add-ons. So it's very much part of the playbook, if you will. Mm-hmm. But add-on acquisitions come with risk as it relates to a lot of things, but integration being part of it. And so working with the management teams to guide them through that process, you really want people who've got that level of interest in getting involved, not just financially, which of course is important, but also operationally.
Yeah, and on the operations side, do you have folks in-house that you drop into companies or have them work very closely with your portfolio companies, or is it more of a network of relationships that you have and you deploy those as needed?
The latter. So we don't have a bench or a stable of operating executives. And part of the reason for that is that each of these businesses is very different one from another. And so we want somebody with as much relevant experience. So if you take someone who is a healthcare executive, they may be amazing, but their experience may be in a different area of healthcare. And so parachuting them into a different kind of company, albeit in the healthcare industry, may or may not be a great fit. So we do like to tap into that network, as you were referring to, and find somebody where we're connecting the dots as closely as we possibly can in terms of their experience.
And do you foresee sticking with the same, I guess, in the lower middle market? Have you had any desire along the way to maybe start targeting bigger companies or different types of situations?
So bigger companies, no, because there are plenty who are doing that. I think that there is, to some extent, a different business going after mid and large cap businesses versus the lower middle market. What we're really doing is our value creation comes from building the companies as opposed to just financial leverage. So I think that these are different parts of the market and they're different skill sets. So of course, a lot of funds scale up in terms of their AUM, and all firms want to grow, and we want to grow as well, and our funds have grown. But we really want to stick at the lower end of the middle market because that's where we think our strategy plays best. It's where we've generated the best returns. And I think if we went too far up market from where we are, our strategy and our type of capital and how it's applied would not be as effective as it's been.
Mm-hmm. I'm always curious to hear about situations where a deal or a portfolio company maybe went sideways for a while, but then you were able to kind of right the ship and then ultimately get to a great outcome. Would you happen to have an example of that? Alternatively, you could just choose one that went really well.
Yes is the answer. So, we've invested in now, as I said beforehand, over 100 companies. And yep, there have been some that haven't worked out, as well as some of the others. Fortunately, we've gotten them mostly right. But inevitably, you have a company that gets off course for one reason or another. And I think that one of the most important things we have to figure out is it an exogenous factor that's out of the control of the management team and we have a good management team, or is it, the other way around? Because one of the important decisions is whether or not you're going to stick with management or not. So one company that comes to mind is a business we had a couple funds ago called Tax Credit Co. And what they basically did was that they provide tech-enabled business that works with large enterprises where they would outsource the tax determining whether or not their employee base qualified for certain tax credits around hiring people because they're disabled or they're veterans or they're from low income areas, there are federal and state tax credits around that. So we were blindsided early on in the deal because of certain legislation. I don't have to get into too much detail on that. And the company went south pretty quickly. So the decision we had to make early on was whether or not to support the business financially and to support the management team. And I'm happy to say, which of course is why I'm telling this particular story, that we made the right decision there. We did continue with the business. We had to restructure it. So there was some pretty tough sledding there for a while, but we gave the management team our full support. We backed an add-on acquisition that ended up being quite successful. And we went from it being close to a wipeout to, I think it ended up being like a 9 or a 10x return. And of course, that was over quite a while. And, the other part of the decision was we had to stick with it longer than a normal holding period. So if a normal holding period is 5 years, this one was more like, I think it was like 8 or 9. But ultimately it was a great deal. But there were definitely some dark days there where we were not quite sure.
Mm-hmm. We're heading into the tail end of the conversation, but I have one question before my last two, which is if you were to pin your success and longevity in your career, what would it be? To pin it to some quality or attribute that you've been able to demonstrate, what would that be?
There are a few things that come to mind. I would say, one is that because we've been doing this now it'll be 40 years coming in the next couple of years, you really have to reinvent yourself. And I think having new blood in the firm is always healthy. You're adding new perspectives as a result of that. But you do have to go through a process of reinvention. And that can be challenging to manage, different points in time. So I think, having an open mind and focusing in on how one kind of reinvents yourself is important. The second I would say in terms of longevity is how much leverage you use with these companies. What I've generally found is that, you can't predict economic cycles. You can do the best you can in terms of diligence on a company and picking the right management team and industry and so forth. But economic cycles can, be your worst enemy. And you can enter at a high point and exit at a low point or lose it in the middle. So if you have the benefit of having a more flexible capital structure that has more capacity built into it, then you can work your way through those bumps in the road and, live to fight another day. So in general, we try to have much less leverage and we try to generate our returns, as I mentioned earlier, off of that process of building EBITDA.
Last two questions. One is, can you tell us about a person who's had a profound influence on you?
I've had a number of people, but, maybe unlike others, I don't really have any one person that stands out. When I got into this, it was kind of learned by doing, jumping into the deep end of the pool. Because, again, it was earlier days. So I don't kind of have that person. And to some extent, I learned a lot from watching people who were doing the wrong thing. So you learn a lot from that as well. And there were plenty of observations I had over the years in that regard too.
Last question. Can you tell us about a charity cause or other endeavor that you're passionate about?
Yeah, so there are two and they're related. One is called Fraxa Research, which does research for an issue called Fragile X, which is an X chromosome related issue on the autism spectrum. And that's a particular interest because our eldest child has that. And then he lives at a place called the Center for Discovery, which is an amazing place up in the Catskills. And they have 300 kids / young adults, half of whom are on the autism spectrum. And so we're very involved with that organization as well.
Wonderful. Well, Jeffrey, want to thank you again for taking the time to chat with us today. It's been a great conversation.
Great. Thank you, RJ.